So learning objective 3 is all about your notes receivable. So again, remember the word note is a loan, and receivable means you're waiting to receive that. So how do notes receivable get born? Oftentimes they are to settle an accounts receivable. So remember, accounts receivable are due within 30 days. In most industries, 30 days is usually the typical window. Um, but some businesses might need a longer period of time to pay. And so they will contact, the other business and say, look, I have this, I owe you money, but I need more like 90 days to pay. And they'll say, sure, we can do that. We'll pay your accounts receivable with a note receivable, but we're going to charge you interest on that. And that is basically how a note receivable is born. Um, it can also be that a company or individual lends money and they have a note receivable. But normally speaking, from a business perspective, if you're looking at most businesses, notes are very common ways in which accounts receivable are extended for payment. It is a legal instrument because it has signatures, there's a date, there's an amount, there's a time period, there's an interest rate. The interest rate, by the way, is an annual interest rate, so which means this is effective for all 12 months, although most notes are very short term. In this case, this one's only 2 months. And of course, it gets signed because that's, these are the folks that are making the loan. These are the folks that are going to be paid. Okay. So the payee basically is the one who's going to be receiving it. The maker is the one who has to pay it. Okay. One of the things that's important to note on how a note works is on the day that it's due, that's called the maturity date. And usually what happens is you're going to get paid the entire loan, the entire note needs to be paid with interest on the maturity date. Okay. Maturity dates are normally expressed on the note as where the date that it was made, when the note was actually created. And it usually states for either a period of months or days. Months are easy because there's 12 months for the year. And so if I made a note with anyone today and it was a 3-month note, we're in February, so March, April, and May. So May, what's our date today? The 18th. It would be due. Pretty simple. It gets a little bit more complicated with days because we tend to use 30-day intervals on notes. So we will say you have a 30-day, 60-day note, a 90-day note, a 120-day note. And literally, if it's to calculate the maturity date there, you literally have to physically count the days. Okay. So it's not as easy to calculate the maturity date as in months because you're just simply flipping the calendar to the month it's due. When it's days, you're literally counting the days, 60 days, 90 days, 120 days specifically. Okay, doesn't always fall. So just because today is February 18th doesn't mean a 90-day note is going to be due on May 18th, because it's probably going to be a little bit sooner than that because of, you have to count literally the number of days. Okay, so that's a trick there. The most intriguing part of this is calculating interest. I hope you have some interest in doing this. But well, either way, it might be more interesting if you do, because we're doing it. So computing interest is relatively straightforward. It's the value of the note that's made. You multiply that by the annual interest rate. Okay, but again, most of these notes are pretty short. So this is an annual rate. So we have to multiply it by that time factor. And there's two ways to do that. If the note has been made in months, then the time factor is the amount of months divided by 12. If the time factor was made in days, it's the number of days divided by 360. So that's basically all you need to know about the time, okay? Because most notes are short term, okay? So the interest rate is annual. We have to multiply it by this time factor to get the interest. So here's a few examples here in these rows. The first one is a $730 note for 12% for 120 days. And so basically you would take the $730, multiply it by 12%. Now remember, this is an annual rate, but the note is only for 120 days. So we multiply that by the time, 120 days, divided by 360 days. And that gives us our interest. So when this note is paid, the face value and the interest are paid at the same time on the maturity date. So they will end up paying $759.20 when this is matured, when this is due. The second note here is a $1,000 note at 9% for 6 months. Again, months, so it's going to be the number of months over 12, right, for the time. $1,000 times 9%, again, this is an annual rate, all 12 months, times 6 divided by 12, gives you 45 bucks. So when this is due on its maturity date, they will be collecting $1,045 that day, okay? And that's basically all there is to it. So in this case here, if you look at an illustration, this is a $1,000 2-month promissory note to settle an account. That's usually how it's done. So first is, because it is going to settle an open account, the note receivable is going to be debited to pay the account receivable. So the account receivable for Brent is going to be credited because they pay the account receivable with a note. Okay. So now the note receivable is on the books. Only two things can happen to notes. They're either paid on time and in full, which means they're honored. Okay, you're honored. If that's not paid in full when the maturity date, then it's dishonored. So a little bit of terminology here. So let's find out what happened to this note. Wolder lends Higley $10,000 on June the 1st, accepting a 5-month 9% note. So that means it's due on November the 1st, because again, June 1st, 5 months, you just flip in the calendar. July, August, September, October, November. That's it, November 1st. The date doesn't change, the months do. So that's the maturity date. So what's going to happen on the maturity date is they're going to be collecting the $10,000 and the interest on that $10,000 all at the same time in November. So in this case, they're going to collect $10,375. The $10,000 is the note. So note receivable has been paid. The $375 is the interest. When you make money on loans, in this case you are, the interest has to be reported as revenue. So it belongs into the interest revenue account. Fascinating stuff, but that's basically it. This says what happens if it's a partial year. In other words, if Wolder has to close their books on September the 30th, right? This isn't paid in full until November the 1st. It was made. So in other words, the loan was made in this fiscal year, but it's not going to be collected until the next fiscal year because they closed their books on the 30th of September. So of that $375 of interest, $300 of interest really was earned in this fiscal year. The other $75 was earned in the next fiscal year. So they basically, this is wrong, on the 30th of September, when they close their books, they will make an adjusting entry showing the interest revenue is going to be on their books. Again, revenue, adjusting entries, right? But they're going to receive that later. And that's what they'll do. When they actually do get paid, they're going to get paid the same amount, But now $75 of that is going to be their interest revenue. The $300 of that is going to go and take that receivable off the books. Okay, that's only for companies that have, a fiscal period that's ending during a time that they've made a note. So here, the do it exercise is more of the same. You have a $3,400 90-day 6% note that was made on May the 10th to settle an account. Okay. The maturity date of the note is August the 8th. Again, because it's 90 days, that's what I was telling you. It was made on May the 10th. If it was months, you'd simply just flip the calendar and count the months. But because it's days, you literally have to count 90 days. So when you count 90 days from May 10th, you'll stop on August the 8th. So that's where the difference comes in. So what's the entry that's Gambit's gonna make in its books when Leonard pays that in full? Well, what's going to happen is they're going to collect $3,451 in cash. $3,400 is the note. $51 is the interest revenue. Okay, and that's what's going to happen. That's how they're going to record it. So was that interesting?